Today is the day we put aside to remember fallen heroes and to pray that no heroes will ever have to die for us again. It's a day of thanks for the valor of others, a day to remember the splendor of America and those of her children who rest in this cemetery and others.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Today is May 27th, 2022, S&P 500 currently sitting at 4127. I'm David Zarling. I'm here with Ian Beachwagon McMillan. Hope you had a great vacation on the beach. I know you're a fan of being able to move whatever you need to move around. That's why beach wagons are a must.
I don't know how you do it without a beach wagon. Props to my wife on getting that. That is 100% her. Of course, now I was in charge of toting it around all week, as I should be.
Yeah.
But yeah.
Does it have big tires?
It does.
Yes. That's awesome. I mean, if you want to take it to the next level, you could put an engine on that thing. Maybe a little driver's seat.
Yeah.
Got yourself a little dune wagon.
That'd be pretty sweet.
It would be pretty sweet. Connor would love it. But glad to have you back. I'm sure it was refreshing. That's our core value number 5, family of families, life outside the office. So I'm glad you guys got to do that. While you were gone, still market data being printed, whether it's currency related, volatility related, crypto, equities. World is our oyster, Ian. Where would you like to start?
Yeah, so a good week last week to take off, pretty uneventful. But this week, seen a little bounce. It's going to help this monthly candle. I know we get a Tuesday. Tuesday's the last day of the month.
Yep, Tuesday's last day of the month. We get a.
So if we want to talk about monthly candles, I don't think that's terribly too early. But some awesome bounces. The giddiness is definitely picked up. And the evidence has, some bullish evidence has certainly come to the surface. But from a support and resistance, the indices still, and some important stocks, right, still what I would call broken.
Yeah, let's talk about some of that. Even if we talk about something like the S&P 500, which on a daily and weekly time frame still have lower highs and lower lows. Now, at the same time, maybe on a little shorter time frame, I know I said daily and weekly, but on a purely daily time frame, you can make an argument for that buyer stepped in and supported the 3,900 area. Whether you want to call that 38.15 to 4,000, and now we're above 40.90, important level from a risk management standpoint. I know a lot of people talking about 4,100. That would be important. So if we're going to come out of a downtrend or out of a correction, you first have to reclaim levels. And maybe today is step one in confirming that process. We'll see. We did have, from a breadth perspective, 2 80% back-to-back 80% up days, I believe.
Yes, I believe that is how that ended yesterday. I know real close to the end. We also had our first positive reading on new highs versus new lows, the first positive reading since late April. That also ended up being just one day. It seems like we'll get 2 days here. But yeah, so there's some positive things happening out there, but so much work to do.
Yeah, correct.
And we're coming off a 20% downtrend, lots of price history to the left. It's going to be, there's going to be some navigating in here, I assume.
Yeah, for sure. There's prior areas of support that broke back in April that have to be reclaimed. And you can look across a lot of different tools, whether it's the NASDAQ 100, the lows from March have to be reclaimed. S&P 500, the lows from March have to be reclaimed. there's so many things that have work to do. But if we were to look back 6 to 12 months from now, you could say this is possibly a start. And that's one thesis.
Mm-hmm.
What would be another thesis?
That this is what we have talked about for weeks. It's just another counter trend rally.
Yep. Correct.
And that's what right? The momentum remains downward. Moving averages are bad. Important stocks like the Apple and Microsoft have not fixed themselves in regards to important levels that they need to get back above. And these things, they feel good, but I don't, and this is not time, and clients are going to realize this. Yes, adding exposure, but this is not necessarily let's jump back in. We're adding tons of new stocks and tons of new themes and things like that. There's still some ice to walking on a little bit of ice out there, seeing if we're going to get to the other side of the lake.
Well, and we can use proper risk management,
Mm-hmm.
right? So you talk about scaling in and increasing exposure. This week, part of it is if we're above 40-90, let's call it the 40-44 to 40-90 area. If we're above that, that's our stop. Above that, we have what appears to be a fairly well-defined horizontal area around 4,300. So that's about plus 4%. And we're at risk of about a little less than 1. So we're about a 5-to-1 ratio. Makes sense. And we can always get stopped back out below this, understanding that we're in a downtrend, but this is how a new uptrend could be.
This is how, right? I don't think either of us have a big enough ego that says, yes, we've been bearish for 4 months and this is just going to continue.
Right.
We
don't know.
To
honor the price levels.
Yeah, honor the price levels. And if we move higher, we move higher. Right? We all know I would say the wall of worry has really added some.
Oh yeah, there's a lot of bricks. There's a lot of bricks.
Yeah, this year.
And here you have the S&P 500 getting a response by buyers or lack of sellers near the daily and weekly average weighted volume of price going back to the COVID lows. So price is responding in a logical area. We're potentially going to log our 30, 80% up day, which some would define as a type of breadth thrust. And we're seeing some internal measurements here that measure what some of the big guys are doing, and there's participation here. And so I don't think we get to look back at this a year from now and if this is some type of sustainable bottom and be shocked by it.
No, there's certain things are picking up now. I will say, right, and this, I want to get your opinion on this, because this usually happens at the beginning of some type of new uptrend, and it was, people really harped on it for weeks back in this, April and May of 2020.
Mm-hmm.
The volume, right? So what are our thoughts on volume and bottoms? I guess
the volume police are out.
They are.
The within the industry, there are those who are discounting price action and weighing more on what volume's doing than what we would do here. And the reason being, price is price. There's plenty of examples of a bottom being established where that's the highest volume, and then you move high, and then you move higher, and the volume is lower. And this happens over and over where we see people come out and say, well, there's not enough volume behind this.
Yeah, they're not serious. And it's just not how bottoms work. And it's not how human psychology works.
Right. Because what if that massive volume at the bottom? Now, I want to be careful. I just used the term massive, an adjective. Everybody's ears should perk up and be like, why? I shouldn't have used that word. Because I think we would argue that if this is a low, if May 20th was a low, it wasn't like substantial volume.
No, this was not, December 2018.
Yeah. Right.
This
Capitulation.
Was not March 2020. I would even go as far, back in your August 2015, January 2016 bottoms,
Right.
you had some really big blow off red days in there. This from a volume perspective, right? I mean, and then it goes back to, will we capitulate in regards to behavior? And it, but it didn't, and lots of things have capitulated, I would say.
Yeah.
Maybe, but the indices, if you're looking at volume in particular, I guess not. But yeah, I agree. There's so many people that, and this happens time after time, people are tired. They just got done selling everything.
Right.
The average human is not going to an equal, an equal increments pile right back in.
Right.
It takes time, and I feel like this volume is always the first level of disbelief when these
Correct.
things start.
Yeah. And it's one of those things where if you think about the process of supply and demand, was the increased volume that we saw May 20th just exhaustion of selling? Now, again, I want to be careful because it's not the same volume we've seen at other important bottoms. So that's not what I'm saying, that this is a bottom. I'm just saying it's natural that coming out of a type of bottom or some counter trend rallies, that's low volume. It's because you're basically, there's less sellers.
Yeah.
Same amount of buyers, less sellers. That means price is moving higher.
And what type of buying is this? Is it covering?
Could be.
I mean, there's lots of things to volume that are more than simply, oh, bulls are in control because it was a big green day, or vice versa.
Right. And short covering is a real thing. If you were hedging going into this environment, it makes sense that there would be hedges in place that would have to be cleared out. And when you clear out a hedge, when you are forced to be a buyer, you have to buy back. It's a thing. And so we'll see. The evidence still is we have these falling moving averages. We have lower highs and lower lows. This most likely is a counter trend move, but most bottoms look like a counter trend move until they're not.
Yeah. Ain't that the truth?
And you're going to have breadth divergences in place. Like you talked about the new highs, new
Mm-hmm.
lows. That's a real possibility because when you look underneath the hood, right, we just talked about S&P 500. But when we talk about something like Apple, Apple's reclaimed an important level near 139. It has another important level, let's call it 155, that it needs to reclaim. So we see we're Bayesian, we take the data as it comes in, but all these there's fairly other names that aren't Apple and Microsoft. And you look at the supply and demand dynamics of something like Google or Amazon, these are just bounces within downtrends.
What's going on with Google is no different than what happened on May 4th. I mean, I think we're in prove it to me territory.
Oh yeah.
And you as whatever, pick your asset. As you continue to take out levels, important behavioral levels, you can, put more chips on the table. But again, this is not, we're so conditioned to buy. We've been conditioned for years to buy the dip that I guess the Fed would come in and save us or whatever the argument is. It's worked. Right. It has worked. It has been reinforced. And I think that's why these slow bleed counter trend rallies could be just what we see.
Right. And it's, we've kind of referenced before periods of time in other protracted bear markets. Again, that's something that takes months and years to play out. I'm not saying that's what this is, but if it is, these are how they start. And, example would be, we like to look at credit, like junk bonds. Junk bonds have bounced pretty hard here.
They have bounced hard, but right back into a pretty ferocious. If you're using
downtrend.
J and K and you want to look at 99 to 100.
Mm-hmm.
And there's also the other side of this that gets lost on many people of there are going to be lots of funds and lots of portfolio managers who are going to use these opportunities as it's kind of someone's throwing them a lifeline and they're getting out.
Mm-hmm.
Right? If you've just gotten slammed in some of these stocks or fixed income, whatever it is, and you're given this lifeline that, hey, you want to get out 10% higher, I guarantee you is that how we manage money? No. But you've got to be aware of how other people manage money too.
Yeah, absolutely. They're in the arena too. It's just one big arena. It's the most competitive arena on the planet. Markets, baby.
And their decisions are moving markets just like everyone else's. So
exactly. You have to be aware when these bounces take place. And again, even I realize using the term bounce also has a bias to it, right? If I say bounce, what that implies is that it will then roll back over and hit the ground again. I have no idea.
Mm-hmm.
But right now, the thesis is these are bounces. Now, I will say it'll be intriguing if we record 3 straight 80% up days.
Yeah, that would be an interesting one.
At the same time, you look underneath the hood, and there's been so much damage done on the individual stock basis that it's hard not to see that these are going to be relief bounces into prior areas of support that are now likely resistance, and then we roll back over. And these are bear markets, right? This is what happens. You get these rallies and they feel amazing and they might be 10 to 20%, but they don't fix anything. So just like we don't use bounces in our investment process, anything else we're keeping out of our investment process that kind of is like the topic du jour? I know I think of narratives. We like to keep narratives out.
How many narratives? Oh my God, the questions I've gotten about Taiwan this week. Yeah. I have no idea. But yeah, I mean, politics and what it all means for what industry or the market or inflation, right? So we talked about, and I remember giving this, right? Every environment is different. We talked about with clients in October and January that if we were entering a big inflationary environment, that one of the areas can tend to be equities.
Mm-hmm.
And that hasn't panned out for the last 4 months. But does that mean that we are, that we've held, we're 100% long and we've held through us because we have we have this overbearing belief that long-term equities are going to be fine because of quote unquote inflation and historical tendencies? No, I mean, each environment on their own. And
the dollar's no. And the dollar just appreciated from them, right?
And it has. And Dave, I don't know how I would say we're kind of in the grand scheme of this industry, our approach is pretty simple, right?
Right.
I mean, things go up, things go down. We're trend followers, and a trend means different things to different people. You can pick what works for you. I mean, it's hard. It's a hard game without including politics in it. Oh my gosh.
Yeah. Why muddy the waters with that? Because we also know that no political party holds a monopoly on market returns. And that's a hard pill to swallow because everybody wants to think that their party is like what's best for the economy and what's best for the
I wish my favorite political party had like 3x the annualized returns of the other guys, but it's like literally neck and neck.
Yep, it's clearly neck and neck. And here we are in a midterm election year, notoriously volatile. So here we are, 20%, 30% corrections on our hands on the broad indices in a midterm election year. Not very surprising from a seasonal standpoint. And I will say that, we're supposed to be heading into a relatively seasonally friendly summer for that type of seasonality.
Okay.
If we don't see that, that's information.
It is.
So important information. We kind of talked about inflation a little bit. Obviously, that is a topic that it typically involves the dollar. We talked on the podcast, I don't know how many month or so, more than a month ago, about the dollar reaching 103, 104. It did that.
That was our target. Yep.
And now here we are potentially with a false breakout, meaning we just exceeded 104 and now back below that. Is that an environment where we can continue to see the dollar fall? And there's plenty of fundamental narratives out there on why that can't possibly be, that the dollar would fall. That probably makes it more likely when people aren't considering the possibility that it could. And maybe that's a tailwind. Maybe that's a falling dollar is an environment that helps equities, helps commodities, those type of things. But again, got to take everything on their own merit.
And we have seen foreign stocks, pick up some relative strength.
Mm-hmm.
So, and we can go over that a little bit in the extended period. But I mean, there are signs from equity markets too that there's some belief in a falling dollar, which I think is always kind of a good thing to have if equities seem to be buying into it. If areas like Brazil or, I mean, even some of these European companies or countries have started to make new relative highs. They are not in dramatic uptrends, but I'm talking about on a relative basis over the last few weeks. They kind of put in bottoms as the S&P moved lower. And so we'll see if that continues, and then that goes back to this 03 to 07 thesis. And it's going to take some time to see if that pans out.
Well, and it's interesting, I've mentioned before that we have some pretty good listeners on here and they'll ask us questions from time to time. And I know we have one person that's kind of asking about a lower dollar. Does that help equities? And what does that look like from a price action from like a tech bubble when the dollar was high, or the 08 financial crisis? And I know when I look at something like DXY, which is the trade weighted dollar index that we can look at, and we look back at those periods, absolutely, the dollar was at a high in
same level, right? 104.
Yeah, well, it was in the early 2000s.
Mm-hmm.
Yeah, it broke above. Let's call it April of 2000, March, April. We're breaking above 104, moving into new highs. I don't know, like that. That's definitely an environment where you had a rising dollar. You had equities peaking out, and then subsequently the dollar rolls over in 02, April of 02, reaching a target or a level of about 120. Does that happen again? I don't know. You got to reclaim 105 for that to happen.
I mean, we got a falling dollar and stocks still continue to go down for another year?
Mm-hmm.
So,
and then on the flip side, you had the market in 07, 08. Yeah, you had a weak dollar at the beginning, but then a strong dollar midway through that when things got
summer
really
08
bad.
When things started to get real,
get out of hand.
Mm-hmm.
And that makes sense, right? That people would clamor for safety. I do think the last resort place to go would be to buy the dollar. If you're talking about the strongest economy in the world, but that gets too fundamental. But so yes, the dollar has different regimes. And so there's times where dollars rising, equities are rising. There's times when the dollar is falling, equities are rising, and vice versa. And so you just got to take each on its own merit. We'll see.
Yeah. What about any other, what do you think about sentiment out there?
I know we had internal discussions about, I know overall clients are nervous and understandable, right? There's a correction underway. And does it last longer? Minus 20% reached on the S&P, minus 30%. And then you look at some individual stock areas that have been in correction since February and March of last year. That's a long time. We're over a year long into massive corrections. And I would say that there's pretty good negative sentiment currently, whether it's looking at clients. I think there's a survey out there that shows, looking at equity investors, that shows there's pretty high cash positions right now. And that can, there's a chart from Bank of America Global Fund Management Survey, and the average cash level is as high as we've seen it since September of 2011. So does that remain? I don't know.
So that's interesting you bring that up. I would say our good friend and your fellow Wisconsinite? What do you call? What are people from Wisconsin called?
Wisconsin. Yeah.
Like the Midwestern Compton?
Yeah.
Nice.
Well,
so he has a good argument about the pile of cash that he put out, and that when you look at money market funds and the those assets, have grown. But when you look at the total market value, that we're still well off where we've been in 03 or 08, right? Because
so as a
you
percentage
saw
of the
big levels in 08, right? Because you saw big levels in regards to, and I will make sure we share this on Twitter tomorrow, and we'll tag Willie, because we definitely want to give credit where credit's due. But
I hope his garden's going great.
It's got to be. And his greenhouses.
Yeah.
I know he's been out there planting. Right. So in 08, you had cash remaining constant, but total market value was plummeting, right? So the value of everything else in the portfolio, the rest of the market was falling, if that makes sense.
Yeah, no, I got you.
Double whammy.
Yeah.
So, we're sitting at 9% of money market funds as a percent of total market value. And that's up a little bit off. We've had a little bit of uptick here the last few months. But, if this was to get serious, you typically see this level get up to 20, 47 in 08.
Okay.
So
that makes sense.
In 2020, we got to 16.
Yeah.
So there's maybe another sign that capitulation just hasn't happened. Our portfolio managers just waiting, like we mentioned earlier. They're just holding out and hoping for that one last bounce to get out. I have no idea.
Well, and the thesis that's out there that I have not heard yet, we've had it internally, is this a slow grind lower?
Yeah.
Rather than a right, because we're used to, the recency bias shows us January of 2018. It shows us December of 2018. It shows us the COVID crash, all of these things with V bottoms. And so is the assumption then that we get a V bottom and it's an aggressive move higher, or are we really in a slow grind lower that just takes time to play out rather than these short, right? Because we're in the third 20 plus correction in 4 years. Typically, again, markets aren't typical. You get one 20 plus correction in 4 years.
Mm-hmm.
So things have changed. Welcome to markets.
I also wonder how much, right? So this would be, let's say it unfolds. This would be the first bear market in what I would call the social media era.
Oh, for sure.
And right. There was I guess Twitter was around. Twitter came out in 07. So yes, technically I think it was around for FinTwit is not what it is today. Whilst like all these areas of social media, YouTube, Reddit, these areas,
there's a lot more readable,
loaded.
A lot of information.
I think the human behavior in this next bear market is going to be on full public display, and it is going to be fascinating because it's not that the emotions will have changed, but I think that the fact that it'll be on full, there's so much more communication, right? And it's not like in 03, the public was quote unquote trading. This is for a lack of a better phrase, but trading together like they do now.
Right.
The idea flow and the talking about it. Some of it's really good. Some of it's awesome stuff. If you know how to, curate
right
meaningful things that are important to you. But I do think, I just think about this next bear market and the fact that everything is so public, and it's really going to be interesting.
It is. If it like you said, if we
get there, yeah.
If this is a month to year type correction, what that looks like is there'll be a lot of noise. There'll be a lot of bottom calling. The relief rallies are going to be impressive, and everybody's going to assume we're out of the woods. And we roll back over. There'll be a lot of weeping and gnashing of teeth, because if you marry a narrative or a story, which is social media is very good at telling, that can be problematic. In the end, I'm going to take price over Twitter. I'm going to take price over any other social media platform, as I know the rest of our team will too. But it is going to be fascinating to watch the very public square in that time, in a time like that. With that, we kind of bumped up to the end of the client portion of the podcast.
Cool.
What I'd like to do in the extended portion is talk a little bit about cryptos, talk about trends and consecutive, because the topic is consecutive weeks, consecutive days. We could talk a little bit about what we're seeing internationally. Anything else you want to touch base on before we close down the client portion?
No, I mean, other than I'm sure we'll do this at the end of the extended version, but wishing everyone a happy Memorial Day weekend.
Yeah, absolutely. It's a time where we get to remember those who gave the ultimate sacrifice, so that we can live in freedom. You know, we pinch ourselves every day that we get to live in a great country like America, participate in a great environment like markets. They're not always easy, but it is sure better than some of the alternatives where the market's dictated for you by a central governance, and we don't have to deal with that. And there's a lot of sacrifices that were made by men and women of this country on our behalf. Can't be more thankful than that. So it's a great time. I hope everybody takes time to acknowledge that, reflect on it, and how awesome it is to be free. With that, hope you guys stay on for the extended portion. There's lots of different things we could talk about. I like that you took a sneak peek at monthly candles. I don't think there's anything wrong with that, considering we have 2 hours left today, the rest of the trading day on Tuesday. That's a place we could, because one of the topics du jour was, we've had 7 or 8 weeks consecutive down.
Yeah,
and I don't know what else defines a downtrend better than consecutive. When you have things happening consecutively, that would be a trend. And so that's information. That's overwhelming supply. And would it make sense that we would get a bounce here? Absolutely. And in this bounce, what's great about weakness in a market is we get to see where the strength is. And I know you brought up earlier in the podcast, foreign stocks. What are we seeing there?
Foreign stocks holding up, pretty well on a relative basis. In particular, got to be Latin America, right?
Yeah.
That stand out the most to you?
Yeah, I would say so. And I think one of the more important charts in the world that's not really getting talked about right now is the Brazilian real. So you look at something like the dollar versus like USD versus BRL, US dollar versus Brazilian real, and you zoom way out on that baby, and you're breaking a rate of trend. You retested a horizontal level, and you're breaking back below that horizontal level being around $5. Again, people love round numbers. I mean, if we continue to correct in that relationship back towards $4 or 4 in that relationship, 3.96, that's going to be nothing. But when we look at the data that shows what areas in the world are most sensitive to dollar movement, it's Latin America across the board. Whether you're talking about Mexico, Brazil, Peru, Chile, I'm not even going to name them all. All of those are super dollar sensitive. And this is why the evidence continues to build that there's dollar weakness. If you got the dollar underperforming the Brazilian real, that's nothing but a tailwind for Latin American stocks.
Yeah, and there's been some, Latin American stocks, you've got a couple individuals, SQM, PBR, and I guess to go kind of with that same thing, Aussie dollar also failed breakout.
Yeah.
And that continues, right? So then that's more of this metals and minerals, kind of same as Latin America. It's kind of what they do down there. And you see now, not gold and silver metals.
Right.
We're talking about other things.
Correct. You're talking about more industrial metals.
Industrials and chemicals too.
Yeah.
Chemicals have remained strong on a relative basis. So we'll see, but there are there's signs. That's all it is at this point, is there's just signs that these could be the leaders should we move into a new uptrend, broad uptrend around the globe.
Right. And we continue to see energy do its thing.
And energy, oh my gosh. It still continues to be, yes, we've had these great bounces, but all these ARK, IPO, online, some awesome 3-day bounces. But when these charts were so trashed to begin with, that these 10% bounces, it's just what it's back into, it's a mean reversion back into the downtrend.
Yeah. And I think of a relationship, and it's kind of related to, another area that is associated with Latin America is energy. And we're seeing energy continue to have the strength on a relative basis,
Every day.
and it's moving up on an absolute basis. And what I'm going to find interesting, and we'll post a chart of this on Twitter too, is just the base of something like XLE versus the S&P 500. So energy versus S&P 500, which goes back to March 9th, 2020, broke out in January of 2022. That base and that relationship targeted about 65 to 68% alpha. Okay, so we're reaching that target soon here. And that target just also happens to coincide with a 236 retracement and that overall relationship of the move that's happened from June of 2008 to November of 2020, right? That was the complete. If you owned energy, you were getting crushed on a relative basis from July of 2008, June of 2008 to, late 2020.
I mean, yeah, energy had its bear market, trust me.
Yeah.
So I guess the fact that it's not, I mean, it did this on its own by itself for.
It was down 90% almost on an alpha, like on a relative basis versus S&P.
So and that's how it got. What at the bottom of it was it less than 2% of the S&P?
Yes, I was gonna ask you that because I know we had that conversation here. I believe you brought up that the percent of the S&P 500 that energy was back at the bottom, November of 2020 was about 2%, and we're back to 5%.
Yeah, we're back to, I think Bespoke had said we're back at 4.9 or 5 or somewhere. We'll call it 5. And that still makes it like, I don't know, the third largest sector. No, the third smallest.
Correct. It's still, I mean, there's still potentially room to run. We'll see. We're almost, my curiosity asks the question, when this relationship reaches quote unquote target. And what I mean by that is, as technicians, we can use bases or ranges to define targets for future price levels. It's not a guarantee. It's just something you can use to identify your risk versus reward. In this relationship, that 65 to 68% move, we're not that far away from there in that relationship. We're about 7% more until you could see that outperformance stall. And my curiosity is going to ask the question, when we do get to target, is that going to be when we start to see the market roll over altogether? Like energy follows suit, right? We talked last week with Dan. One of the areas that's, I believe it's the second or third largest in the S&P 500 is healthcare. Something like XLV is holding above 127. Is that when we see 127 break on XLV? And that's when we start to see the capitulation lower, where everything's moving lower into fall. And we don't see a bottom until October, which would be classic, right? Because we tend to see tops and bottoms in October or March.
Especially being a midterm year.
Yeah, absolutely. Absolutely possible that this relationship in energy versus the S&P continues until reaching target. And that marks the end of a quote unquote bounce. And everything then starts to fall together. I don't know. It's a thought.
Day by day.
Day by day.
So you said we were going to talk about cryptos.
Yeah. What do you think? What do you think?
They, right. I mean, there was for most of 2022, the big thing, in regards to cryptos and markets, or one of the larger things that got pointed out was the correlation between the NASDAQ and Bitcoin.
Yeah. What do you mean by that? Like that they were moving together?
Yeah, they were moving together.
Okay.
So you've now seen, right, the last few days, and both Bitcoin and Ethereum have been in these, I think the charts are pretty ugly, both consolidating, haven't moved for, 3 weeks at this point, basically. Well,
and Ian, I don't know if you've looked at the sneak peek at the weeklies yet, but we're 2 hours away from recording some new weekly lows that break.
I saw Pratty had mentioned that last night. I know he'd still be doing his chart work. I'm so proud of him.
Yeah. Can't wait to have him back.
Yeah. There's been no bounce there. You want to talk about, I would call it a decent guide for risk on, risk off in the market. Bitcoin topped last March 2021 too. 62,000.
Right.
Now we did move a little bit higher in November, and that was a good equity run.
Mm-hmm.
But for all intents and purposes, when you look back on this, in years, you're gonna notice that February, March 2021 was a top.
Well, you had all the sentiment around it. You had
Bitcoin just continues to rotate under 30,000, and it does not have to play this way out, but any technician knows that consolidations tend to resolve in the original direction of the trend.
Yep.
Which has been down for the last 7 months. We can call it 2 months if you want to say it rallied from 30 up to 47. Not a great look.
And you can always buy it back. You don't have to be involved. You don't have to be in the airplane. You can land the airplane.
And if it gets back above 30,000, that's not a reason to feel stupid.
Right. Like the nesting that we're seeing, I call it nesting energy that we're seeing right at this 30,000 level. If this breaks to the downside, and I'll be honest, this looks like it could be an ugly Memorial Day weekend.
If you think Bitcoin's going to 100,000 and you sell today, and then next week it jumps up to 31,000, and you're like, "Oh, I missed out." Are you really that upset that you missed out on the first 10%?
No.
I mean, when you give yourself, when getting in at that level gives you such a better
risk management
point.
Your capital is your inventory. You run out of inventory, your business is over. So it's taking a lot of risk to be involved with Bitcoin below 30,000, below, Ethereum below 1,800. These are some pretty important levels where we would want to see buyers show up, and maybe they will. Maybe this weekend actually is. We look back and remember the buyers that showed up Memorial Day weekend. That could be it too.
Yeah.
And we move higher from here, but we might as well use proper risk management techniques. We don't have to be involved at this point when the risk is higher, further downside based on the price action. Let price prove itself. Let the buyers prove themselves here. Get Ethereum above 1930, get Bitcoin above 30,000, happily participate.
Yeah. Then we can talk about the next bull run for cryptos, but
yeah, which I want to happen. Like, I like it.
I would love it. I would love I would love to have a reason to log back into my Coinbase account, to be honest.
Yeah. And it's really, it's fascinating because some of the more, I'll use fringe, alternative coin, whatever you want to call it. I mean, some of these are off even worse, and they're below important levels. They're below levels that had previously been, that really, when I look at things, your Ethereum and your Bitcoin are really the last two cryptos holding on to levels that have significance going back to 2021. Everything else has lost levels that were defined in 2021. So it'll be interesting to see if these last two big boys can hold up. Considering
or maybe crypto goes into its own bear market and stocks go higher.
And here's the beauty: like, people look back at the .com bust, and some are like, "Oh man, I hope we never have something like that again." Do you know what's the beauty about that? Is the things that came out of that, the companies that were actually real. Mm-hmm. And there's nothing wrong with the market doing its job and thinning out what are inefficient companies, which are either fake or they're just inefficient. They're not a value add to what they're trying to accomplish business wise.
They don't do anything for society, and the market will figure that out for you real quick.
The market will figure that out. And that's what we love about markets is, yes, they're a brutal arena, but you find out who has the staying power, and you get the Amazons of the world.
Yeah.
And
that is absolutely
correct. The things that come out of these environments are what's going to be beautiful. And so never view what we say on here as we're either pro or anti crypto. Really, we're just pro markets, and markets do a really great job weeding out the fake, the false. And so if your protocol, if your tokenization, if your business plan is viable, the market will reward it.
Yeah.
If not, it won't. It's wonderful. We should all be thankful for that. It's another thing to be thankful for in a free United States.
Another thing I find as sort of a bearish overhang for this area is, okay, so cryptos, they're denominated in US dollars.
Yeah.
So, all think these things don't have earnings. I guess, there's there's fundamental factors behind them as to what their use cases are, but not fundamental in the fact that like there's conference calls and like there's earnings estimates and there's forward guidance. I mean, these are, denominated in the dollar, and we've had the dollar move down, right?
Mm-hmm.
In theory. So you would think that would be a tailwind. It doesn't seem to be. Or it has been, but whatever else is pushing this lower is just overwhelming even that backdrop.
Yeah. I mean, the only thing that I would say is if you look at if DXY peaked on May 12th, that does appear to be coincident with the May 12th pretty long candle in Bitcoin.
Mm-hmm.
So we'll see. That really has to hold, and it looks like we're on the verge of breaking that level today on a closing basis. So really important weekend coming up here for crypto markets, which are always open. And to be honest, I'm actually thankful that markets aren't open over this weekend, because I think it's appropriate to memorialize those individuals that made sacrifices, and it's okay to slow down, shut down, reflect, have a time to think rather than markets being open all the time. I think that's appropriate, but cryptos aren't. So we're going to find out what happens over the weekend with those. Anything else, Ian, you want to touch base on before we hang up and join the market call with our team?
No, other than continue, this is it's a good bounce. We're still with downward momentum in equity markets. We'll see what comes out of this. We're going to, like you said, I know it's your favorite word, and I think it's so appropriate it's a Bayesian approach. And I cannot express to you all how okay Dave and I are with being wrong about things, if that makes sense.
Yeah.
It's a total acceptance of being wrong. And sometimes you have periods where you're rarely wrong. Sometimes you have periods where you're wrong a lot.
Yeah.
And technical analysis lets us know when our thesis is kaput.
Right.
And should markets continue to move higher, and this looks like it's going to turn into something more than a bear market rally, we will continue to participate. The toe dipping, there will be more toes put in the water, and we will move higher with markets.
Right. You still got to swing at fastballs, and just because you miss a fastball doesn't mean it was the appropriate pitch to swing at. Mm-hmm. And so I couldn't agree more. I don't even want to add any more. You said it well. We appreciate everybody listening. We hope you guys have a wonderful, relaxing Memorial Day weekend, and we'll touch base with you guys again in a week.